And here we are off to the races. I think we are live. I never know. It's kind of weird. You just never know if you're live on LinkedIn or not. I see the timer come up right there. There's like a 6-second delay or something. But I'd like to welcome everybody out there viewing. We're going to be talking about trucking rates, trucking news, maybe a little bit, well, I would say debates, but I don't think any of us have gotten a chance to watch it yet. But I'm Kevin Hill here with Brush Pass Research, joined with my co-host as always, Casey Larkin over at Farelanes, and our special guest this week, Benjamin Kowalski of Freight 360 fame. If you haven't,
pleasure to be here.
I know, right? If you haven't listened to Freight 360 yet, you need to. It's been around for a long time now, right?
Yeah, I think about at least probably 4 or 5 years, give or take, somewhere around there, around 2019, 2020, I think we started it.
How many episodes are you in now?
The 240, 230, something like that. And those are all just weekly. So give or take, a little more than 4 years, roughly 50 a year, once a week. I think we've only missed maybe 1 week in that entire time where we might have re-released one piece of content. But apart from that, been pretty consistent with it.
You have. And, I checked out your latest one, which was great, getting back to basics, right? Moving that first load with a new prospect, potential customer, and kind of the rigmarole that we all go through trying to get that. And you know what? It's winning, even if you don't win that load, it's winning losing the battle and winning the war, right? There's things to do that set you up for that next opportunity with that prospect, because as you guys mentioned, and we've all been through it in sales, in life in general, is the time you invest to get to that point. It's just you're still just a starting point. There is no defeat,
just a start
there, but it is a lot of time and effort just to get there. So you better not screw it up by and screwing up doesn't mean losing that opportunity. But setting yourself up for the future opportunities, because that's where the money is anyway.
Correct. My two favorite analogies just to that point, right, are that like sales is one of those, like I almost view it much the same way I've always viewed sports, like kind of the competitive nature of it. And it's very performance based. And in sales, like you get 0 points for getting to the 1 yard line, just like in football, right? Like you can drive all the way down that field. If you get stopped short of that end zone and you don't put any points on the board, it's all, I don't want to say it's all for nothing, because you still should have learned along the way, which helps you improve in other things. But at the end of the day, you score 0 points if you can't capitalize on all that effort, for sure.
In Casey Larkin put it in this terms, right? You could hit a 350-yard drive, but you flub the iron, the wedge, it's all for naught.
Classic.
Who cares?
Drive for show, putt for dough. That's why you got to spend all your time within 100 yards when you're at the practice range, putting and chipping, hitting approach shots.
That's right, man. Don't blow up. Eliminate the 3-putt. But I mean, ask Seahawks fans, right? They know what it's like to get to the goal line and not be able to punch it in.
Which is I really like that analogy. I was watching a piece of content the other day. It was somebody, I can't remember who it was. It was a current. Not that Tiger isn't current, but it was somebody that was more younger, obviously, in the PJ. And he's like, this is basically how you shoot. If you're a 14, how do you get to a 10? How do you get to scratch, right? And then he basically explained exactly the outline that Tiger has. And the long and short of it is, it's just avoiding the mistakes. It's not really trying to hit, the perfect drive, make the 20-foot putt, hit the 3-pointer from half court, whatever analogy you want to use. It's really just avoiding the errors and then doing that consistently enough. And that's how you win, right? Like it's far less about trying to hit a Hail Mary or do something crazy to get the big win, and almost everything in life, but for sure sales.
It is. It reminds me, we were at the Broker Carrier Summit, and I forget who the speaker was, but it's that compounding that 1% incremental improvement, because you can't improve 1% the same thing day after day. It's exponential, right? It doesn't make sense in a lot of ways. But if you can, if you have, each step in the process, let's say you can improve by 1%. That adds up to average to above average. And I go back to the baseball analogies, right? What's the difference between a 250 hitter and a 300 hitter? What's the difference? It's very quantifiable.
Yeah.
1 hit per week. 1 hit per week goes from average to a Hall of Famer.
To Hall of Famer. And it's a great segue, because the other thing that we talked about in that episode that's been on my mind a lot, because we've been working with a lot of clients, this is a big part of freight brokerage. It's executing the ask. Lots of content, lots of shows around how to get shippers and things like that. But if you do all of that, and again, like we're talking, you can't score with it, like you're just getting very frustrated. And I really think that like the most successful folks in our industry, they look for those opportunities, like you said, on the margins. It's the small percentage of things that you can do differently or better that differentiate you. Because we're in a commoditized industry. Truck's a truck based on maybe age, type, quality. There are some definitely qualitative variables into securing the capacity side. But if you just put those apart, we're all kind of operating out of the same market, on the same footprint, and the same rules and the same game. The competitive advantages are those marginal differences you do. It's the follow-up phone call. It's asking about a load that maybe you didn't even win because you genuinely care how it went. Your customer's stressed out. They're calling you for help. Their hair's on fire. They're getting yelled at by their customers because it's not delivered when it's supposed to be. And then you can't get the truck for whatever reason. Like, I think the more successful or tenured brokers realize, like, you call and you ask them, hey, I know we didn't get a chance to be able to help you on that, but just how did it go? And it's a simple thing that you can do that most people don't. And it's not a lot of effort.
Yeah,
exactly. And it shows so much about how you would treat their freight if you and when you do get it. And it helps them. You're showing them, not telling them. And I think that's also a big differentiator in successful people in any industry, for sure. Sales is doing the thing, not just saying you can do the thing, right?
Right. And then helping people arrive, where you want them to go by themselves, right? They don't want to be told, right? They'd rather be shown and, realize, come to the same conclusion that, okay, maybe Benjamin is the guy that I want to be working with. And
life of the margin, Casey.
Life of
the margin.
Something that George was talking about, George Abernathy, when we had him on last week, is, obviously the market is not ideal right now. Margins are, from what we're hearing, right, shrinking, especially in a world where it's hard to make the margin, right? You got to make sure that it's positive as many times as possible. You know what I mean?
I agree with that. The one thing that I maybe have like a different view on is the market's effects and directly to the performance. Maybe an individual, when you get to a big company, you're not going to be able to, just because of the numbers. Like, you're going to be affected by the market much more, I think, in a larger company than in a smaller company. But I think for the individual broker out there, or the smaller freight brokerages, again, back to the margins, there are so many opportunities, and even a down market where a shipper cares a lot about service and cares more about the care that is taken in the service with their freight than getting the cheapest rate on it, right? Now, it takes a lot more phone calls, a lot more emails, a lot more research to find them, a lot more conversations, a lot more legwork. But when you do find those diamonds in a rough, if you will, of the customer that has the needs that really align with the things you provide as a company, there's lots of margin out there, and there's lots of freight to be moved, and there's plenty of profit to be had when you find those things. I think the frustrating thing is our industry is always kind of approached it of, just be patient, make a lot of phone calls, whatever freight you get, you move. And there's something to be said about that. However, you also end up with a lot of freight that isn't really strategically aligned with your other customers, your carrier base, or even your operations. And you're struggling to make it all 15% margins to hit these average. And the reality is, like, some of those customers will never pay above 9 or 10 because they don't ever have to. Some are more than willing to pay 25 or 30 because they are willing to, and they know what they're getting in return for that margin. And I don't think there's enough thought in approaching which customers that might be the best fit, or even the attrition within your own customer base of going, hey, we've been moving freight with all these guys, 20 customers all year. Like, we're making 80% of our money from 20%, and we're spending 80% of our time on our least profitable ones. Like, sometimes you got to make that hard decision to cut those to find more of the better ones. And human beings just have this huge fear of loss that is far more powerful than the hope of gain. So they just don't want to let anything go they have. We've got this bias that once we have it, it's ours. And we just don't want to let that go. Right. And then we pay the toll for that.
Right. Yeah. The Pareto principle. Do you want to spend 80% of your time worrying about the, 20% of freight that, it doesn't drive as much revenue as the rest, or should you be spending your time with those customers that are spending, or generating 80% of your revenue to figure out, where there are opportunities to add more value for them and continue to kind of grow those relationships that are already, doing well, right? Kind of betting on your winners, if you will. It's interesting. I don't know if that's a decent segue, Kevin, or not, to looking at like Transfix, right? It looks like they sold their brokerage this week, but they're continuing to focus on their tech. Conversely, right? I think there's some updates on the Convoy tech that Flexport now has their hands on.
Yep.
Seems like they're focusing on tech, and Transfix is as well, but was able to get out of the brokerage business. Let's see if those core competencies are, what they're shaping up to be.
Yeah, that's interesting. You have both of those things you mentioned, Transfix and Convoy, right? The big tech players that had brokerages, and the brokerage kind of sunk Convoy. And on the flip side, Transfix got out of the brokerage and focusing on tech. But yeah, Convoy for brokers is kind of still out there. Flexport announced that earlier this week about what they're doing, and kind of that internal, or not internal, but that capacity tool and kind of load management, and just doing more of a technology only play.
Yeah.
And
then Transfix,
what do you think?
Yeah, go ahead,
Kevin. Oh, to that point, like, what would you say is, and I'm sure there's many variables that went into the decision that we're probably not even going to ever be aware of them, maybe till after the fact, but what do you think might have been more the primary driver? Like, to me, the obvious one seems it's like one of two. Either you're going after and wanting to capitalize on maybe a higher margin, lower operating cost business that has a little bit less risk in a variable market, as opposed to the labor intensive side of brokerage. Do you think it's as obvious as that, or do you think there's something else at play?
On the tech versus brokerage?
Yep.
It's all about valuations, right? I mean, and valuations come down dramatically on the tech side, but at one point, it's 20 times or 20 times revenue.
Yeah.
Or third of gross revenue, which is, or 40% of gross revenue is kind of a general thumb of a traditional brokerage, right? Or 20 times revenue on the tech side. What do you want to do? You want to do tech.
But what if that's coming down to like 8 or 10x?
It's still better than brokerage.
This is true.
Still better than brokerage, right? And that's more traditional, right? 6, 8, 10 times revenue is still much better than if you do if you do 50 million in brokerage, a third of that, what is that, $20 million sell, right? Roughly. Or do I have my numbers wrong?
Bigger leverage, bigger exit for sure, bigger valuation.
Yeah. I wouldn't say it's easier. It's certainly not easier. But if you're gonna shoot for the sky, might as well shoot for the sky, right?
It's a fair point.
And that's what VC money. VCs want, that multiple return, right? They don't want to invest in.
They want that 50x
freight brokerage, right? That's So that's the biggest driver of all those, I think.
Make the 20 bets because you only need one to pay off, or 50 bets or 100 bets to get one to pay off. Yeah. You're investing in freight brokerages. You're betting in one, and that one hopefully works, right? Like, you just see typically a very different approach to financing each side of it.
Yeah. And I think there's less risk in investing in freight brokerage, right?
For sure.
If you have the right team
volatility.
in place, right? If you have the right team in place, they're going to generate a pretty predictable return. You have the market swings, but even in brokerage, the market swings aren't as dramatic as they could be, right? You still, the ebbs and flows of what you pay a truck comes and goes, but for the most
needs
part,
to be moved, right?
Yeah, things have to be moved in a steady business. And we're talking about a freight recession that is, 26, 27 months in the making. But going back to your first point, Ben, about down markets, it's better to be in a down market with a good economy than a down market and a bad economy, right?
Yes.
Those are two big differences.
They're huge. And that's a lot of where my focus has been, at least on forward looking. Where I think things might be is more to do with what's going on consumer spending, what is happening in the overall economy, I think is going to be more of the driver than the attrition in the trucking capacity or in the freight brokerage piece. How much goods are going to need to be moved? What does that look like? We had so many swings through the pandemic between low inventory to reduce costs, which traditionally made a lot of sense in the 2010s, right? Then leading up to it, and also you could have kept inventory at a lower cost with lower interest rates. Now you're in an environment where they needed to massively increase their inventories during the pandemic because they needed products to sell. And then on the other end of that, right, then they're bringing it back down because the cost to hold that inventory is weighing on their financials significantly different than it did pre-pandemic. And I think a lot of those shifts make it very hard to determine what the future may look like, as well as the other things that are always going to be questions into the future. And now you've got a lot of things related to inflation that everyone's looking at and what things are going to look like. Are consumers still going to spend the same amount 6 months, 3 months, 2 months? And no one ever knows the answers to those until they happen. But to me, I just have a preference for the fundamental businesses like freight brokerage, as opposed to the chase the demand, get the profitability later side. I just enjoy one side more than the other. And, I don't think that means one's better than the other by any means. But I think, to your point, Kevin, you could mitigate a lot of the things and your risks in the freight brokerage side in a way that you really kind of have to guess if you're playing the venture capital game and you're making these long bets, because you can get the demand, but we've all seen lots of products, even outside our industry, that did really well and then they fall apart. Whether it's Clubhouse or what anything is, that have great products and then people run to it and then they don't for whatever reason, and it kind of comes back down. And there's really just no way to gauge that other than waiting and seeing. So.
There isn't. Brent Wallace here. An intriguing factor I would like to know more stats on is the success ratio when an operating company, transport logistics customer, engages in M&A of a pure SaaS technology company, which is interesting. I wouldn't say it's probably very good. I think all M&A, doesn't really turn out all that rosy at the end of the day.
Well, the tech side of things, I think it's hard, right?
Yeah.
I don't know. A lot of these big guys, they like to build their own systems. I know a lot of them have disparate transportation management systems, for example, for different business units. There are some stories, right, of big companies in the space, not necessarily asset based, but acquiring technology companies and sunsetting them, right? Paying those rosy 20, 25x valuations back in the day. And, but it is interesting now, right? I mean, I think, right, Flexport was able to get the Convoy technology on the cheap and, with the hard lessons learned, right, on top of that cautionary tale, right? It's interesting to think about this kind of, it seems like there's a second wave of freight tech coming along here. And, there are some people, right, in the industry that made a whole bunch of money. George is calling it, generational wealth. So you've got, this smart capital coming into the space. And it seems like a lot of these technology companies are a little bit more niched than some of these automated brokerages or things like that were hot in the first wave, and this money that was coming in from San Francisco, which maybe necessarily didn't have all that much expertise or experience in the freight markets, right? I mean, people saw it as a final frontier, and probably didn't necessarily understand all of the problems, right? Probably the experience that you need to solve some of this stuff. So it is a cool time, even though that the markets are down. I think there are some cool technology companies up and coming in a more niche capacity that could be valuable for somebody that has assets.
I think that's true. And I think you hit on the thing where my mind went to with that question, right? Is I think you see a few things happening. One is I think there are folks out there that build SaaS companies for our industry that have not enough practical understanding of how the industry functions, but yet they're able to build a product that from the outside looks as if it can add all this functionality, or whether it's shiny object syndrome. But when you really look at what it does in regards to the value back to the business, some of them, like, it's just another way to do things. Maybe it's a little easier. Maybe it looks a little better. But if you're going to spend a significant amount of money, eventually, whether it's in a quarter or a year or whatever your time frame is, that value needs to trickle down to the bottom line. Otherwise, it was a poor decision. Like, full stop. You can't buy a company to add value, and then if your bottom line doesn't reflect the increase in either profitability or efficiency, to me, it probably wasn't a good decision. And when I get to talk to a lot of those companies or vet them or look at them, Kevin, you and I talk about them a lot, even off air when we connect. And it's like, some of them really hit the mark. And I think, make it easier or faster or more effective to broker freight, to do tracking, to communicate even with amongst your team or even your customers. And for sure, I think that can reduce costs, which is a value add, right? But some that are just a new tool for the sake of being a new tool, or just a new way to do the same thing, to me, I think a lot of the brokerages that buy those are really just trying to do what we were talking about earlier, which is get more of that leverage for that exit, to be able to say they're a tech company, they're a 3PL with a tech division. And the reality is, it's like, it's a TMS that functions the same as every other TMS. And like, yeah, they own it. And yes, there's additional value there, but it doesn't really make the brokerage more profitable, more effective, or more operationally efficient. And to me, I guess I fail to see the value or the point in some of those. And I feel like maybe you could still exit and get the bigger leverage, and hey, someone else buys it, it's their problem moving forward. But to me, that's where I try to at least put my focus if this decision is going to be made.
Yeah, you're exactly right about that. There are a lot of tech companies. A lot of them is very heavily competitive in most places now. And Brent Wallace here, second part of this, because we talk about X ratios being significantly higher, 13-20 of the pure play tech. Is evolution juice worth the squeeze? That's a good question. And talk about technology, and Ben, your point of does it hit the bottom line? I think a certain part of that is you buy a lot of things that go on the shelf and you just don't use them because sometimes you just don't do the training. You don't have the investment, people investment to make it work. And I think you find a lot of products out there in all industries like that, but heavily in tech because of all the money.
And it's a really good point. I was listening to, I don't know if either of you listened to the All In podcast, but pretty good show. Mostly focuses obviously on like the tech side of things and some current events. But what they were talking about this week from last week's episode was a lot of the tech companies got hit. I think it was Friday, and I think again, the numbers definitely, I'm not going to recall exactly, but I think Salesforce took like a large hit, like maybe like 20% or something on the stock price, and a few other ones. And what they were discussing is the same thing we were talking about related to AI. They're like, look, you've got companies spending billions of dollars, right? And the assumption is that all of that spend is going to translate into profitability in the bottom line. And it's been the better part of a year where these companies are spending massive amounts of money. I think they estimated something like $750 billion was spent into AI across the industry. Like that's a large nation, or at least a small nation's GDP. Like those are enormous numbers. And the reality is now that they're looking at quarter and quarter after this, after all this money's been spent and all the valuations went up and everyone has huge expectations, the profitability per share is kind of just hovering around the same. And they made one really fundamental point that you just touched on, Kevin. And one of the guys on the show had said, he's like, look, I own a few large companies. He goes, I could mandate, let's just say 1,000 employee company that everybody's got to use this new product, right? Whatever it is, AI. He's like, but the reality is like, they're still people. And like, they're still maybe going to try it. They might not be comfortable and they might like doing it a different way. And to be able to get people to change their behavior, even if you've got a product that does make their life easier, is still a difficult thing to accomplish. People resist change. They do, even the ones that want to embrace it, like it's slow to move, it's slow to be adopted. And the bigger the company is, the slower that adoption is. And that really is reflected in a lot of the larger companies. They're spending the most money. And yeah, they got the most people, but making one engineer 4 times faster, if it's a startup, is real value real quick. You do not get 4 times the value by giving that tool to 1,000 engineers. They don't all of a sudden operate like 4,000 engineers, right? Like you don't get the same economies of scale because of the behavior and the size of the company. And it doesn't correlate directly. And I think a lot of that's true in products into our industry, especially with the larger companies. By this, it should make everyone's life easier, maybe, if it's adopted, and if, right? And I think those are the risks that often get overlooked intentionally.
Does that enable a world where, you know, it's freight market anyways is run by smaller companies? I remember an article that I think Craig Fuller at FreightWaves posted probably about a year ago, you know, talking about the growth in, you know, motor carriers and speculation back in the 80s. Deregulation was that, you know, you'd see a lot of consolidation in the space, but it's kind of been the opposite of that.
Yes.
It's interesting. You're saying, right, is tech something that helps smaller companies become more efficient, but as organizational inertia theorem inevitably hits these like larger organizations, you don't get the economies of scale, even if you are implementing AI. Does that make it harder to compete with the smaller companies that, you know, maybe they're able to keep a tighter grasp on their culture, their core offering, where they think they deliver value and focus on that? It's interesting to think about.
It is. It's interesting to think about. It's interesting that you're expanding your vocabulary there. The inertia theorem. I like that.
Google it. Check it out.
I can't even pronounce it.
I couldn't repeat it either. Sounded good though.
I know, it's good. Ben, you want to give Casey a lane to throw in to Farelanes, see what we come up with.
Why don't you throw in Nogales to Modesto?
Nogales to Modesto.
Man.
Are we thinking van or
reefer? I was looking at this morning on a bid.
There are, but yeah, it's interesting. We are now in the cycle where, you know, everybody from 2017, 2018, that class of freight tech companies are now at the end of that VC cycle, right? We're getting to the end, and they are not young companies anymore. They're in the startup world. They're mature, and it's time to exit or to do whatever the end of the life cycle is. So it'll be interesting over the next couple of years to see who the winners are, who aren't quite the winners, and see where all this plays out as we see this new niche group of technology companies that have been formed over the last 2 or 3 years, how they pan out going through this stage too.
It is going to be interesting. And I think to what you were saying, Casey, right? Like there's almost this like inverse relationship where the tools seem to benefit the smaller companies more than the large. And also like you had coming out of the pandemic, everybody working from home and this massive increase in just small businesses being started, right? Side hustles or whatever. So I think more people are more comfortable, one, starting a business. And I think we're becoming more comfortable as a society working with smaller businesses. When I was younger, like the generation before me, like you worked for one company for your career. Like that's what we learned almost in high school in preparation for choosing your career, which is totally upside down from where it was. And I think there's a lot of great takeaways because that's my favorite part of our industry. Like 3 people can compete with a company that has 3,000 people. A 4-person trucking company compete with a larger company in some ways, right? And I think to me, like that's better for the economy. I mean, so much of our economy is based on small businesses, so much of the tax incentives that like, I think the more we see individuals starting their own companies and doing this better, because I think when you get to the bigger companies, even when I use them for service providers, like telephones and things, for example, the smaller companies tend to have better services. They tend to care about the product. They know the owner. They're invested in their job. They care about the outcome. If I talk to somebody at Verizon or Comcast, they could care less if I am happy or unhappy and whether or not they can even fix my problem. Right. You call a company that's got 30 or 40 people, they'll follow up. They'll give you that service. They care to make sure it works in a way that like, I think we're getting more accustomed to. And I think we used to expect, then no longer expected, and are starting to expect that type of service and just work product, if you will, to be on the levels that it really should be. People should care about what they're doing.
Yeah, I think it makes it a lot easier to care about what you're doing as well if you're, not out of Verizon, right? Customer service rep at Verizon it's got to be pretty far from the C-suite and getting anything, actually implemented. Organizational inertia theorem, reference number 2 for the show.
And it's interesting because the larger you get, the more successful you get, the more bureaucracy that is involved, and it's hard to adapt. But and it goes with Ben's point. 25 years ago, or 30 years ago, 40 years ago, whatever time frame you want to put on it, I think larger companies had more panache, right?
Yes.
They had more credibility, and small businesses were a little sketchy, or they're looked on with not a lot of credibility, and that's flipped. I think the larger the organization is, the more cynical you are about it. And the smaller it is, they're go-getters, they're hustling. This is going to be great. I'm going to get a great deal. It's going to be great quality. Everything's going to work out. And that's just kind of flipped.
Yeah. Edward Bernays coming back to bite these brands in the butt.
I know, right? And going back to brokerage and technology, and I forget who said it a while ago, but if you look at it, you can have a 3-person shop or a 4-person shop and buy the technology off the shelf now,
right,
to compete with any organization that you want to. Though the real hurdle with that is figuring out how to do that.
Yes,
because it's not a simple task of putting everything together, getting the automation right, getting the sourcing right, the pricing right. It's not easy to do, but it can be done if you know what you're doing.
And there are a lot of people in the industry right now that I think learned tough lessons. Maybe, some people say trying to boil the ocean the first time around. Talking to, a guy right now who came from Convoy, and he's now at, a more niche brokerage. And, we've got Sprinter and Straight Box data over here. So, he's trying to think about how to leverage the data, we're going to share with them to create an automated pricing tool to be able to, then know what the price is for Sprinter or a box truck and be able to automate some of that stuff. Right. So to get back to Brent's point, is the future of the industry, right, being able to win more freight, right, at positive margins, but have that margin shrink a little bit. Figure out how to incrementally add value to your customers and incrementally, add revenue to the bottom line. If there are tech platforms out there that help companies do that, I think that could be, one of those success stories. Not totally sure on the stats or the success rate, but I don't know, thinking maybe that might be a cool way for a company in the
life in the margin.
Living
in the margin. I think those are good titles for podcasts or what have you in this industry. Something with margin, right? Life in the margin, living in the margin, because it is all about margin. So we have Nogales to, what was it, Fresno, or was it
Modesto or
somewhere in the
Didn't have
valley?
too many on Nogales. I don't know how close Phoenix is to Arizona. If there's another drop city, we might be able to look at.
And Dallas in there.
All right.
Dallas to Modesto.
$2,600. They're about
2,600.
They're about. Looks like maybe. This is Oklahoma City, Lancaster, Sunnyvale. Did you make the bid yet with the customer?
No, still working on it. Actually, one of my clients is. I'm just helping them work through the bid, but it was just the first one that came up. Did you say add a drop? Do you have the ability to add multiple drops to get rates in there?
Like LTL?
No, just like a 1-pick 2 drop. I thought I mentioned you were like, hey, I'll add a different drop. You just mean like kind of change the drop city. I didn't know if there was.
Yeah. Change the drop city. But yeah, Ben. So these are from like purchased invoices.
Mm-hmm.
So straight carrier pay.
Nice.
$1.79. Let's do Louisville, Kentucky to LA.
Angles.
Some stuff that moved on that. Just dry van.
Okay.
Yeah.
About $3,000.
About $3,000. People want to go to Southern California. The ports are not in the same funk they were.
No, we see ocean volume picking up. I think I read something as well. Air volumes are picking up too.
Yes.
I don't know. Does it feel like 21?
Not at all.
I know a lot of that stuff's also moving up through from Mexico now too, like a significant increase that's been increasing significantly. The one thing that I'm anxious to see is how that's going to play out. I think it was maybe Craig put out an article, something, or maybe I picked up on FreightWaves. It was basically showing like the increase in volume, right? Because of the nearshoring from Chinese companies is a big piece of it in Mexico. But the trucking market was still so loose that even though you had this huge spike in demand for trucks coming out of Texas with a lot of that freight, it was still being absorbed. So you weren't seeing the fluctuations in rates yet. But as the market tightens a bit, I think you're going to see a lot more of that volatility in some of that areas of the country.
I think so too. I don't know how it's going to affect the market as a whole. I'm interested to watch it as it plays out, but I think it's going to have an impact somehow, some way in trucking because it's I know for the last decade it's been at pretty well full capacity coming out of Mexico. So you add on additional freight to that, and it's got to reverberate somehow through this loose trucking market, right? There's got to be some kind of cause and effect, and whether it could turn in the market, or it could at least move the market. Let's say move the market.
For sure, too. And I think you also have two other things at play. One is, right, you have the hesitancy of the companies in the United States to bring product from that far away because they're still feeling the pain of the pandemic, right? Even though that's, behind us somewhat. However, you also have the fact that, like, we basically fueled China's growth, and both of the countries benefited for the past 20 years, where China is growing at like double-digit growth rates through 2019, 2020. And there's so much trade back and forth because they're growing, we were growing. That is slowed on their end too, right? And as well as they're making more of their stuff for their own country. And now they're moving lots of manufacturing into Mexico. It's really shifting, I think, the global supply chain. Not only is it shifting, but you have the fact that, like, the countries are actually at different growth rates, which is significantly changing what's going to come in through Long Beach, what's likely to come in, I think, in Long Beach in the short term anyway. And I think in the long term, the preference is to move them over closer into North America because it's cheaper to ship from there. I mean, if you can make it there and ship it, on land, it's a lot cheaper than putting it on a boat, then on a truck, then on another truck, or then on a rail, then on another truck.
Yeah,
it is. Yeah, it's for the supply chain continuity, right? I mean, it's much cleaner.
Yeah,
because just about anywhere in the country, you can get on a plane in the morning and be wherever you need to be in Mexico by the afternoon.
Yeah,
and not a long flight either. I know, like here in Dallas, you can be in Monterey.
Yep.
Hour and a half, right? You're landing in Monterey, Mexico, which is a big deal. And speaking of Dallas, right? If there's enough volume, because the warehousing space is pretty limited from Dallas, it's 6-hour drive from Dallas to Laredo. There's not a lot, you have San Antonio and Austin, and but Dallas is the big hub where the warehouses are, and they're building more and more each and every day, it seems like.
Yep.
If that gets jammed up a little bit, then it jams up the trucking market in Dallas, which is a big trucking market. Yeah. And that could have some cause and effect that flows through. And certainly not going back to 2021, but anything that gets us out of sub 4% tender rejections, I think everybody is hoping for. Right, days of 6 or 7%. I mean, like,
I'll go even a step prior to that, right? Like, and maybe if maybe the rejection is gonna precede this, but it's like even just quoting things, right? Again, looking at the contract versus the spot rate, like it's been economically upside down now for 2 years. Meaning, like, you get a better rate to contract something over a year than what you would pay to get it today. And I mean, it just, one, it makes no sense. Like, economically, we know why it's occurred, because they all need a guaranteed capacity. The shippers paid a premium that drove the contract rate above the spot. And now you don't have the volatility, because if you got a guaranteed rate, there's no reason to take a spot load for less money. You're not going to reject that load. You only reject the load when you're getting $3,000 and the spot market's going to give you $4,000 for the same lane. So until those things come back, and to be honest, I'm kind of shocked they haven't normalized by now. I really kind of expected the end of last year for them to meet and probably go back to the normal volatility into like this year's produce.
Yeah.
And they still aren't. You see some lanes, like when I'm working through, again, any bid, you'll see a few here and there where like the contract has now met spot and they're like touching, but I can't even recall any lane that I've looked at recently where they've gone to the traditional relationship of contract below spot. And I think everyone thinks of this. Again, I even started that topic off with like, I can't wait for it to change, because to be honest, it makes it creates more opportunities for us to help. The market functions economically the way it kind of should. However, there's a silver lining in every issue and every problem, right? Like there's always an opportunity. And the opportunity is that like, yeah, they're upside down, but that means if I'm talking to a shipper, I should be able to get them a truck in 6 hours for less money than they contracted. And I can't remember if that has ever really occurred where you could literally call a prospect and be like, I could probably save you money on a last minute load that you got to pick up tomorrow. Like that is unheard of and shouldn't really happen economically or fundamentally. But that opportunity has been there for 2 years. And like, that's an advantage. That's an advantage in a lot of ways if you're understanding how to execute on it and how to utilize that. If you're having the conversations you should be having to understand what's going on at the shipper. And I think that's usually the missing piece with brokerages that say their margins aren't where they are.
Right.
They're usually just trying to use some easy way to do it, just quote everything at this and we get what we get. And it's like, no, you actually got to put the work in to actually have the conversation, because that shipper's freight is not all created equal. What of it needs this type of service? What needs this service? How can you actually help them in a way that the person that wasn't willing to have that conversation didn't understand and couldn't execute on because they didn't take that extra step, right? And it's simple, but it's not necessarily easy, right?
And that brings me back to your conversations, you and Nate Cross, right, on Freight 360 over week in, week out, right? And this is what we talk about in our conversations, Ben, a lot of times is having those conversations, right? Having those conversations is fundamental, right? It's fundamental to get more business. And it is an advantage over everything else, even the automatic quoting, right? Because then you're getting low probability, low margin opportunities, which is part of the business model. That's fine. But as a salesperson, if you're a freight broker, don't worry about that. You need to know your shipper. You need to know your customer. Back to the fundamentals, right?
Yep.
Know your customer, know your shipper, be that consultant, work through the problems. And that's where the higher margin, higher value loads are, right? The loads that everybody wants to move.
Yes.
It's not the shippers that are trying to overload the truck, and it's, they're trying to pay the cheapest rate, and, you steer yourself away from that part of the market into the part of the market where you can add value. And I hate that phrase these days.
But it's so accurate, right? Because when people hear or in the market, and there's tons of flack about this, right? On like, oh, you got a big margin. You got paid this amount to do this on this one load, right? Here's the thing that I think gets lost, and you hit on it, is if that situation aligns with all three, the truck, the brokerage, and the shipper, and everybody gets what they want in that particular instance, like there should be an outsized margin because you spent more time to understand, and then you spent more time to find the right fit for that need. And there will be a larger margin if you put that work in to align those things correctly, right?
Yep.
But I think the other thing we talked about makes that harder. And it's that, like, I think a lot of tech companies just assumed that shippers, when they said, well, we just want to put a rate in and we just want to be able to get a truck. And they tried to execute on that without the understanding of how the market functions. And it doesn't work that way. And just because you give them that interface that allows them to choose quickly and book a truck on Uber to come show up, and it never shows up because you booked it for $1 less than a mile than you should have paid that afternoon, and you get frustrated, that's not a problem with the software. That's a problem with how the tool was basically advertised or marketed to the shippers, because it was never going to be able to do that in the first place. Like, just because you give them what they're asking for doesn't mean you can execute on getting them the result they actually need. And then it puts people into this habit of all freight's created equal, all trucks are created equal, and we don't need to have a conversation. Just give them an easy, shiny interface for them to choose their trucks and their rates. And it loses all of the understanding in the middle. And it all starts with the assumption that every shipper and every person you're talking to also understands the freight market. They're a shipper. They ship widgets. They make widgets. They ship whatever product that is. They access the market with us or with a trucking company, but they don't necessarily understand the nuances and time, rate, a tight area, a loose area where there's no trucks today, but there might be this afternoon. All those nuances are the value we add in that conversation. And sometimes you have to educate the person you're talking to, and not in a way where it's like condescending or like, I know this and you don't, but it's asking questions and helping them understand like why the thing they're asking for sometimes just can't be done and why sometimes it needs to be done a little differently. But if you don't spend the time to have those conversations, all of those opportunities are just lost because nobody's even getting to the fact that they exist.
Right. Absolutely. It's cool. It's interesting, right? You could be the niche guy, like the expert guy, you know, who knows, you know, you're going to have to get a tarp or whatever extra service, or you're going in or out of this area or working with this shipper, this receiver that, you know, is troublesome. A lot of value to be provided on that side of things. Kevin, I know you hate the word, but
I can't get away from it either. So, you know, I need to find a new phrase besides add value, because I think it's just cliche now. You just need to add value. It's one of those things that one of those words that have gotten to the abstract, right?
Yes.
Add value. Well, what does that mean? You know, it's not concrete at all. It's not a concrete word because
I think it is concrete, right? It's like reduce like your operating cost, your cost of goods sold would be one way to add value.
Well, you just described it before, right? It's like this shipper, this receivers, you know, if you have that information, that is information that you talk about indirect costs, right? That it can be costly and time and money if you don't understand those nuances. But if you know, you need a tarp, you need this, you need that. If you're going in here, you have to book an appointment, and they're very tight on appointments. I know this receiver. I have other customers that deliver into this. That's where it is. And we can do a finance analogy, because we're trading transportation.
We are.
We're market makers, right?
Mm-hmm. An axe, baby.
And the shippers are the retail investors in a lot of ways, right? And the carriers are kind of the operators, right? They know their network, they know their business, but they don't know the entire market.
Mm-hmm.
But brokers know the entire. That if you're a broker, you need to know the entire market. You need to know what's going on, because the shippers, right? They're the retail investors. They're making widgets, as been said. They're not in. I mean, they ship their products, but they're not into the market. And that's what you have to do. So, you know, adding value. You described it, right? You described it. And in a way that adding value has no meaning or no, I don't know, gravitas, as George would say, gravitas.
Yeah, like the weight behind it, right? But I think you guys both like did a good job of really identifying what that, you know, value is. Like on the carrier side, even just in one load instance, like, okay, the transportation industry from the trucking side is incredibly inefficient. There's lots of dwell time, lots of wasted time at shippers, lots of wasted time between getting from one place to the next with you're not loaded and rolling, right? So if you really understand the carrier you're working with and what their need is to be more efficient, you can provide it to them. They operate more efficiently and more profitably. And if you can align that with the need of one of your customers, where that specific instance matches with their need, they both win. And that's where the margin is created. It's not because somebody argued and beat a carrier down $500 and argued and manipulated a shipper up the other 500. If you're doing it and you're understanding what you're doing, everybody should be winning. And there really should be no need for the animosity. But everybody gets frustrated and offended when they see what somebody else did. And then now it's there. And it's like, to be honest, there should be more win-win-wins if you're understanding what you were just saying and what you were saying, Kevin, which is like, where are the inefficiencies? How can we make both of them more efficient? And then they get a little bit of the efficiency and they win. They get a little bit and I get a little bit for putting the whole deal together. And then everybody wins, right? Like it doesn't need to be conflict and yelling and anything other than that, right?
You create efficiencies, but you don't let people know how you do it, right? You know,
that's the magic.
Yeah, I know, right?
Secret sauce for sure.
Secret sauce.
I mean, as well, like we've been talking about, you can help somebody be more efficient, save on the cost side of things, and then there's also the, you know, how can you find opportunities for them, right? I know it's a down market right now, but the potential to, leverage your experience to help them identify areas where they could be doing things differently. And, I don't know, maybe selling more widgets or whatever it may be.
Well, it's helping their customer service, right? Because I mean, if you're making widgets and you're delivering those widgets, that is part of your customer experience, right? Is that delivery. And being good at helping your shipper customer deliver their goods on time in full to the expectations of their customers is something I think is undervalued, right? Or something that people don't look at seriously enough.
And I think they're everywhere, right? Like, and I loved how you said you increase the service, right? Like one of the things I noticed very early on when I worked at a big box brokerage was like one shipper would have like very stringent, maybe like requirements when they work directly with carriers, like whether it was higher insurance or whether it was the age of the truck, whatever it was, just say higher standards, right? Well, and they're willing to pay a premium. Okay, what we were able to do in a lot of instances was like, I could find probably an older truck with maybe lower service, right? That normally gets paid a lower rate, maybe in some instances. But once it goes through us, like the communication's different. The driver doesn't have to do a lot of those things. I'm willing to be able to do it. The billing, the invoicing, the communication. But in addition to that, let's just say that truck has an issue and breaks down. Well, if that shipper worked directly with that truck, they're SOL, and that's why they don't want to do it. But if I'm in the middle, I will get them transloaded. I will get someone else to pull that trailer. I will find some way to get that load delivered with another truck to delivery. And my shipper doesn't have any of the headache. So in some instances, it works out great. And that driver wins because he gets some freight he wouldn't have got access to directly because they wouldn't work directly with them. And the shipper gets to win because they got a truck that they didn't think existed. Because from that shipper's point of view, they're like, there's no trucks here. And then you go look at them, like, there's like 40 of them here. You guys wouldn't work directly with any of them, but we can work with some of them. We can add insurance to cover you in first position so you don't have to worry about that piece. And we can recover the load if the guy breaks down. We can work through any issue that may come up in a way that a shipper isn't built to do, right? And those are just all examples of, I think, what we're all talking about of adding value in a way that is like outside the standard, beat the truck down, beat the shipper up, make some money in between until you can't do it anymore, then find some more business, right? Like one is you're doing it considerately and you're caring and you're learning and you're improving. The other, like
you're ripping and running.
Yeah. And any business that does that usually has a short tenure. Like you can do that for a short amount of time, but the chickens come home to roost eventually and you start losing customers and you can only hold that facade up so long before it starts falling apart.
Right. Yeah. I mean, to your point, right, there's so many carriers out there. There's only 20 people getting on a routing guide, right? So like you need that broker there to assume the risk, find the truck, get the goods from A to Z so you can sell your knickknacks or widgets or get your toilet paper to the store. People are freaking out and making a run on them. It's the one thing I always think about. You guys brought up the crazy markets of, I don't know, the P word. I don't like using pandemic, but
hand sanitizer and TP.
Yeah. Hand sanitizers and TP. It is a different world. Different world, than now. I don't think we'll ever see a market like it again. I hope not, because it probably means something bad's happened.
True that.
Yes. Sometime. I mean, there were a few that
unless we have
terrible,
like 25% GDP.
Yeah.
Which would be weird.
Yeah. I don't see that anytime soon.
Me neither. But it would be weird. It would be cool.
That's a word for it. PPE.
That's right. Michael remembers everything.
Yes, I remember PPE.
I never see that acronym again. Be a happy man.
I know. I know. Well, I think we'll wrap it up here. Ben, thanks for joining us today.
Pleasure as always. Thanks for having us, or myself. I'm used to being on with Nate.
Thanks for joining us, Ben. It's a lot of fun.
Casey, any final words?
Yeah, not too much. Happy Thursday. Appreciate everybody for joining us here for a little bit, if you did. And yeah.
And Ben, I you can leave us with your tagline.
Ooh.
Whether you believe you can or believe you can't, you're right.
There we go. I like ending the show like that.
Only way out is through.
Exactly right. Only way out is through. If you think you can, or if you think you can't, you're right.
All right,
there we go. Well,